Hello, this is Eric Boyce, CEO and Chief Investment Officer for Boyce & Associates Wealth Consulting, and welcome to Charts and Chat for November 9th of 2025. Start off the chart pack this week by discussing the government shutdown, which is now the longest on record. We're roughly 40 days into this now. The chart that you're looking at is a couple of days old. And you can see here over time, going back to 1976, that we've had varied lengths of shutdowns, and we've averted a lot of shutdowns at the last minute. But there's a very contentious atmosphere in Washington right now, and was a brief glimmer of hope on Friday, and won't get into the specifics other than to say that I think there's still kind of political posturing going on both sides, and a lot of rhetoric out there that's not helping the circumstances. And as we're going to see in the next chart, that there are estimates that of economic deterioration that's being caused by the shutdown, and we'll go ahead and take a look at that now. What we have here is various estimates of economic impact from the shutdown. And so, you can talk about KPMG here, kind of at the low end, not, insignificant. Let's be clear about that. $10 billion of lost economic growth per week. Barclays at 11, Treasury Secretary Scott Bessent now at 15th, and then 15 billion, and then all the way up to Moody's Analytics that estimates that we're losing $30 billion a week in economic growth from the shutdown. So with that in the background, let's look at the equity markets for a little bit. Here we have a chart that plots the Bloomberg Magnificent Seven, which I think we are all very familiar with those names by now. And you can see how really going back to the pandemic that these have done, obviously extremely well, unless you bought them all here and we went into 2022. And NVIDIA, for example, was down 50%. But if you back those out of the 500 basket of stocks, that essentially this is the S&P 500, but if you back out the Mag 7 and you're left with the 493 other remaining stocks, quote unquote, in the index, you have a line that looks like this, much less remarkable in its ascent. And I think it really just underscores how overall narrow the market has been over a multi-year period. Something else that is kind of salient, but interesting nonetheless, from my point of view, is that with these increasing deficits and really no care or concern whatsoever on either side of the aisle to curb our deficits, that we're having a lot of treasury issuance. And where we're getting the most issuance actually is in the short end of the curve. So treasury bills, very short-term instruments. And you can see here that really from July on that we've had a tremendous increase in treasury issuance, and we've got all of these different measures here that I think are pretty important that Apollo puts together for us. But the long and short of it is that with that increased supply of treasuries, you've got lower prices, and because you have lower prices, you have higher yields. So we've actually artificially inflated our short-term yields. And again, one of these conundrums for the Fed that I think there's, a case to be made for lowering interest rates, and certainly the consensus believes that we're going to have another rate cut. We'll see. Inflation is sticky, but you also have these interest rates that are a little bit higher than they would be, just because you've got this odd supply dynamic that's going on that's driving your prices down and holding your yields up. So here's another interpretation of that with the supply of U.S. Treasuries, and you can see here in the green, these represents T-bills, and you can see, just how short-term the Fed's, the Fed, well, not only the Fed's balance sheet, but really from a strategy point of view at the Treasury, that they're really leveraging short-term yields, which again we know are we have a very very odd yield curve now. We've got a little hump, but then we do have some upward sloping yields over time. But as yields become volatile on a short-term basis, I think it puts a little bit more risk here if we wind up having inflation and short-term rates come up. That's just going to put more fiscal pressure on the government to pay, as these short-term instruments are having to be rolled over at higher interest rates. Again, that's a risk, but it's just the way where we are right now. And again, more issuance, as I said in the prior slide, leads, connotes more supply, which more supply, when you put more supply on the market, it tends to bring prices down, which again tends to hold your yields up. We talk about valuation. The Buffett indicator is also, it's pretty interesting to look at this. This has been around for a long time. Buffett indicator, obviously named for Warren Buffett, a very astute investor, which is defined as the size of the U.S. market cap in dollars relative to the aggregate GDP or economic growth. And you can see here's 2025. This is where we stand on the market cap to GDP side. And this is the cyclically adjusted price to equity or price to earnings ratio, Shiller CAPE ratio. So think about that. Just basically think about PE, but kind of cyclically smoothed out. And so, one can certainly argue that we're expensive from a trailing PE side, which is essentially what this is a proxy for. So we're expensive here, but we also have a very highly valued market cap relative to GDP. And you can see here, going back at different moments in time, 2000 when we had the tech bubble, 2007 was the eve of the global financial crisis, 87 obviously was Black Monday, and then 1980, which is really kind of the advent of the massive response by Fed Chairman Volcker to very high inflation. Good for perspective. Yes, we're expensive. As I showed you before, it's a very, very narrow market where the non-Mag 7 really hasn't performed as well, and from a valuation standpoint, is really not as egregiously out of line as you would think. Here we have forward earnings per share, kind of following along that thought. Here we've got the overall S&P 500 here in the dark line, again, influenced by Mag 7. We've got mid-cap 400. Valuations from a forward earnings per share standpoint have gone up in every instance here, whether you're talking about small caps in the green down here or the mid caps here in this line. They're all moving higher, but you can see that the rate of ascent clearly from the S&P 500's point of view is much greater than these other two. Another indicator that I think is important to bring into the conversation here is the percentage of stocks in the S&P 500 index that have outperformed the overall index. And again, to the point of narrow leadership, again, this oscillates over time, so it's not always been this bad. We've had pockets in 2024 and not so much this year, but where is a very broad-based kind of rally. And 24 was a relatively good year for the market. 25 being a good year, but that has not been shared by all participants. In fact, we're pretty close to kind of an interim low of the mid 20s here as far as the percentage of stocks within the index itself that are actually beating the index. Here we have some reflection on the earnings season so far. As a headline here from Deutsche Bank would indicate that earnings beats are running very strong, and that is true. And typically, you get earnings estimates that kind of get ratcheted down ahead of the quarter reporting season, and then you're just kind of setting up management to beat those expectations. But Uh, but oddly enough, I mean, beats have been fairly strong and they've been above average. The earnings beat itself, the aggregate beat has been above the average beat, if that makes sense. And so, this is also very much adding to the positivity of things. Obviously, not the case in 2022 when there were some disappointments, but you can see here that since then we've really tracked above this long-term average. Some other interesting viewpoints on the global market. We talk about international diversification as being important, which it is, but what's interesting here is that the influence of the international markets on the global indices and the global overall market is waning. You can see here market cap weight as a percent of the developed world. Again, this is not emerging markets. It's actually not even China either. But you can see that you've got the United States now over 70% of the market cap weight of the developed world, and Europe is now less than 20. So you can see that divergence started to take place after the global financial crisis. And with that, again, looking at global indices where the U.S. is much more heavily weighted, you've got a price to earnings, and this is a valuation metric. So here we've got the forward PE of the U.S. market clearly ahead of the global ex-U.S. So much more reasonably valued here, if you will, because if you go back 1980, this is 1970. You can see that line of best fit. It's kind of like somewhere around here for the global ex-U.S. Market, and you can just see this massive divergence right now that the global stocks are very inequitably valued relative to the U.S. Here we have margins. We've talked about this a lot, and this is something that actually confounds economists because of the tariff regime that we have, despite all, that we still have expanding profit margins, and you can see that here in this chart from BCA Research. And that it's good if you're on the winning side of this. If your margins are expanding and you're beating estimates, you're doing well. And as you just saw a couple slides ago, that the average earnings beat has been above the long-term average earnings beat. And you can see that stocks, get a little bit rewarded if they beat the estimate. If they miss it, then they're summarily penalized a little bit. And this is actually, I'm surprised it's not even greater with the lofty valuations that we have, particularly on technology. But if you raise guidance, you really get a bump, and if you lower guidance, you get penalized a lot. So, not having visibility in a time where there is increased uncertainty out there is really gonna create some volatility within individual names. And then if there's enough of that kind of instability there, that's going to create more volatility for the overall index, which we have seen a little bit more volatility, but overall, from a relative basis, the volatility is actually still relatively low. Quick comment here on private credit and credit quality overall. Again, we think about this as being kind of the non-bank banking sector. So this is private credit that's as a share of household and businesses debt and loans. So this would be like outside of the traditional banking sector, and that number, as we know, has gone up for many years. That's not a surprise. So the non-bank sector is becoming more important, and this is actually a chart of relative. So this would be like their private assets under management as a share of household and business debt and loans. So it's a different metric, but it's very emblematic of the rise of private credit over the last couple of decades. This, I think, is important from a timeliness standpoint. So we talk about what are the risks to the economy. Credit exposure would be one, but we've had, again, we have a relatively strong, reasonably strong economy, I should say, with some definite chinks in the armor there. And we talked last week about the K-shaped economy, and that you've got those with means at the upper income cohorts. They're spending, they're happy, they're very confident about things. And then you have people at the lower end of the income spectrum that still feel like inflation's very high. They don't feel like they're getting ahead, and their discretionary spending is much lower. So we do worry about credit exposure, and here we see that underperforming loans have picked up a little bit, but again, it's not catastrophic. I mean, this is on the aftermath of 2022 when we had high inflation, higher interest rates, and so it came down consistently. But we've definitely troughed, and now we're kind of staring at the potential for continuing rising delinquencies and perhaps defaults. It's just a question of how high that's going to go. Here we have gold, which generally outperforms during times of uncertainty. So we obviously, have some uncertainty with regard to tariffs and growth, and policy risk is out there. Certainly, geopolitical, maybe a little bit, yes, not as much as I would have given credit to last year. And but again, investor sentiment in times like this where there is uncertainty, you'll see gold catch a bid, and that certainly has been the case. And you can see this almost parabolic move, and then subsequent kind of retrenching off the peak. But you look at gold relative to its 200-day moving average, still well above that. So technically, gold is very stretched right now, and you can see gold as a percent of its 200 day moving average. You can see it's basically 20% above that. So we talk about IPOs versus private deals. This is kind of a measure of the difference between the private and the public markets. What's very interesting here is that we've seen a lot more activity on the private market, which is notated in the black here. And I realized put these slides together, I didn't have the reference and the supporting annotations here, but this is from Bloomberg, and so the black represents private transactions. The number of $1 billion plus deals has certainly gone up over a period of time, much more in excess than we've seen initial public offerings, IPOs. They've also risen, but not at the same pace that we've seen from the private markets. So we're entering the holiday season. It's important to kind of think about how that's going to look, because a lot of retailers get 40% of their annual sales during this time frame. And as we all know, people, with regard to tariffs, and even are tariffs going to impact prices? Are they even going to impact supply chain issues? So people are getting out a little bit earlier this year, and so I think now is a great time to look at the estimates that are out there. This is the National Retail Federation data, currently looking for, call it about 4% year over year. And you can see how that compares with the last couple of years. And down here, we've got aggregate sales numbers expected to, really, continue a long-term trend. So you think about, how this looks relative to inflation. We've had a couple of banner years here, 2020, 2021, again, pandemic. So people were ordering a lot online, and I think this is kind of an aberration, if you will. But even from this elevated stance, going from basically 2019 to 2021, that was a relatively high jump. We've actually continued that trend in a somewhat kind of quasi-linear fashion. To bring it all home, again, market's expecting a relatively good year from a holiday sales standpoint. So we talked earlier about the probability of a rate cut, and this is very specifically the probability of a quarter point cut at the December Fed meeting. And so, obviously that probability has been higher, and there was, many months this summer and heading into the fall here. This is September 11th, but heading into the fall where the consensus was for two, maybe three rate cuts, and some were even looking for four. And I said, this is, honestly, we didn't have enough meetings to have four rate cuts. But the point being that there was a lot more optimism to that, and then that definitely went down. And of course, Fed Chairman Powell's comments saying that there's no guarantee of a rate cut in December because of this conundrum that they're dealing with kind of the sticky inflation thing that is still out there, and some of that's tariff driven. But then to offset that, then you've got some labor market weakness, which is real, and you've got businesses that aren't hiring, but they're not really laying off either. So we're kind of at a point of stasis. But in any case, that feeling seems to have been taking hold. So again, just to put a bow on this, the Fed has a dual mandate of stable prices, stable employment. Prices remain sticky, but the labor market seems to be softening up enough that I think that there's a feeling that we've got about a 2/3 probability here of a rate cut in December. So we look at the labor market. Again, it's not telling a horrible story. It is weakening a little bit. Again, we don't have the Department of Labor data. We have ADP, weekly employment, so we're going to have to take that for the time being. And this data usually kind of correlates positively to the government data. It doesn't always lay on top of each other, but again, showing some positive employment data here near term. So again, labor market is softening. We do know that, but it's not egregiously so. And you can see here that numbers are actually moving higher. More job growth information. You can see maybe a little bit of a tick up here, but again, this paints the picture that we've been describing. The labor market has been kind of, softening up here for some time. You've got this dip because of the tariffs and the kind of just a crazy uncertainty during the month of April. But it does seem to be moving higher. Again, like all these things, I mean, you can't take this as like a trend necessarily. You have to watch the data as it pattern forms over time, and you got to be careful of these little false, little upticks here. But I am an eternal optimist. But I think the best thing to say about labor right now is it's a little weaker, but it's not in bad shape. So on this final slide here, talking about the labor market, we'll just show you some of the data that's being imputed now by some very smart people that are looking at state level data. These are state level claims for all 50 states. Again, states are open. It's just the federal government that's closed. And so they kind of aggregated all this data to kind of give us a sense of maybe where the federal data would be coming out at if that was being published right now. And we can see here that the 4-week moving average is in a downslope. That's not surprising. It's what we've been describing. But again, looking at it relative to these trends over the last several months, it's not evidencing catastrophic level behavior. And then also looking at continuing claims, which is really measuring kind of the more persistency of unemployment, if you will. And these are the people that have been unemployed for a while. And you see that number is moving higher. But again, we were there in June, July, so it's not overly concerning yet. This trend is certainly concerning because at some point these people, the longer they're unemployed, they just get more despondent, and then in some cases they even pull themselves out of the workforce. And we don't want to see that, but this all paints the picture, like I said, just to reiterate, and then we'll move on, of a labor market that's slowing, but not in just a huge decline. Here's a visual chart that I thought was pretty stimulating here. Something I don't think about necessarily a whole lot, but I think is important nonetheless, is that you have essentially a quarter of the population that has a subprime credit score. And again, we don't think about that much. We think about the availability of credit when credit gets tight. It's usually not to this cohort. And It's very interesting to see that you can get very bogged down in all of these little shadings here, but just suffice it to say that uh, a lot of the population is subprime credit quality. So another chart that I thought was really interesting is the kind of the distribution of tech labor. And we've been talking about Texas as being a destination point for a lot of companies that are relocating. I know this in my volunteer job as a city council member that that there are a lot of jurisdictions, including ours, that are very active on economic development, trying to get companies to relocate, not necessarily just from Canada, or from California rather, but from all over the place. But this is interesting that California at one point in the around the pandemic was had 20% of all tech jobs, and that is now closer to about 17.25%. Median age of a first-time home buyer hit 40 years in the latest survey. This is reported to us data from the National Association of Realtors as reported by Arbor Research. And I think this really just speaks to the affordability issue overall. I think this is pretty compelling data. And you think about younger workers that are can't afford housing right now. They're having to rent or live in with parents or whatnot. A trend that has a pretty meteoric rise to it. So again, this is reflective of the fact that you have to be into your almost your peak earnings years these days to be a first-time home buyer. So another couple of data points here on the economy. This is the Institute for Supply Management. Their PMI, which is their Purchasing Managers Index survey. Everything above 50 represents expansion. So we've been teetering on the brink of economic pullback for some time, but it has remained positive. I'd say maybe less so than we saw maybe towards the end of last year, beginning of this year. But again, nothing that gets you incredibly worried. New orders index really in the same boat. Again, anything kind of in the 50 to 55 range is reasonable growth. It's not excessive growth. Anything above 60 in either one of these diffusion indices represents really outsized strong growth, and we just don't have that now. But it's really not that bad. Here we have some more delinquency information, credit quality. We've got auto loans, and we've looked at this. We looked at this a little bit last week, and we have over the last couple of months. But we actually feel like there may be a topping out here in some of these delinquencies for some of these categories, and specifically I talk about auto loans, credit cards, and mortgages. So the worst, if we're going to, from a relative standpoint, the worst that we're going to see may be behind us. Again, that's, we want to see that trend shape out a lot more before we can say with any definitive nature. Now, but the one thing that is clearly not moving in that direction are student loans. And so here we represent a period where these repayments were held in advance by a federal order, and repayments were reinstituted here. And you can see that almost immediately that younger generation experienced a spike in those delinquencies. So this is the only part of the market which represents about a little over $1 trillion, maybe 1.25 trillion, that is really seeing some stress right now. And the rest of these, again, are at I think at best right now just kind of topping out and flatlining here, and maybe even in a best case scenario they're actually beginning to perhaps roll over a little bit. That's all we have for the chart pack this week. Hope you've enjoyed it. Have a great week, and we'll talk to you again soon.